Well, I'm here with Sandip, a CIO of Whittier Trust. You've been a repeat customer, shall we say, and we've been very grateful for the wisdom you've shared from the stage. Sandip, we were talking a little bit earlier about this total portfolio approach that Kaya dropped yesterday, unveiled yesterday. And multifamily offices, on average, tend to be a little bit more flexible, a little bit more nimble than perhaps some of the larger allocators. Tell me a little bit about how you think about traditional forms of asset allocation, MBO, SAA. How does that work at Whittier Trust? What's your philosophy?
So, look, we have the luxury of building portfolios over a very long-term horizon. So a couple of ways in which mean variance optimization immediately breaks down is that the original theory is more suitable for single period optimization. We are multi-generational. And so immediately we're in the multi-period problem setting. And unlike the public markets, financial data is so hard to deal with. It can be lumpy, it has big fat tails, as we know. And then you throw in alternatives and private market investments, and it does get complicated, right? Volatility can be underestimated or underrepresented. So are low correlations, simply because those investments do not get marked to market on time. And so over the years, we have learned to think about asset allocation and the construct of a portfolio more in terms of the investment goals that it allows an investor to meet. What is growth? What is income? What is preservation? Which of your constraints can become binding? We know alternatives are illiquid. If you have a need for liquidity, that immediately puts a cap on how much you can invest there. So it's fun to have that flexibility, and we're excited that we keep working on more intelligent, more nuanced, and more selective portfolio solutions.
Well, Sandip, you always tend to be on the frontier of thinking on this, especially on the what you might call the ultra high net worth side. One of the distinct characteristics we talked about yesterday from the stage of TPA is this idea of true competition for capital. Instead of private debt, you've got 12%, fill up your bucket. Public equity, you've got 32%, fill up your bucket, and then we mash it all together.
Correct.
There's true competition at every marginal dollar. You're competing for attention.
Correct.
So when a new opportunity comes up, whether it's a direct investment in, let's just say, a hard asset or a GP on a private debt strategy, how do you make sure that all of them have kind of their fair say and are considered without these overly bucketed approaches?
So one of our biggest advantages, and I would even hold it out as a luxury, is we can create the structure for what the allocation should be and in what range it should exist. But we are absolutely not compelled to fill it to the hilt, even if the opportunity set is lacking. So we can step back. We're stewards of really long-term capital, multiple generations, 30, 40, 50, 60-year horizons. And so if opportunities are somewhat limited in this bucket or sandbox, we will just not pursue it because we need to fill it up all the way. And so in real time, with fluidity and intelligence and selectivity, we can just trade off risk-return payoffs without putting a label as to where it came from and say, this is asymmetric enough, this is attractive enough, where this should get top dollar right now, and then we'll kind of switch to a different so-called asset class, keeping that structure in mind so that we're not hopelessly adrift.
So many good sound bites there. Fluidity, ensuring that all things kind of have a fair say. Long-termism, critically important when you're thinking about delivering on purpose and investment outcomes. So, Sandip, it's always a pleasure. Thank you so much, and we hope to see you again next year.
Great to chat with you.